The International Monetary Fund has delivered one of the most serious economic warnings to the United Kingdom in recent memory. This comes just weeks before the Chancellor's autumn budget, and it raises tough questions about the state of Britain's economy, its fiscal strategy, and how global investors now view the UK. This warning has led to headlines like this one from the Daily Express. Nightmare for Rachel Reeves as UK slapped with worst living standards warning. The figures are a blow to the Labour government, which has made raising living standards a priority. Let's break down what the IMF actually said, what it means, and why this could reshape the economic debate in the months ahead. Rachel Reeves is facing another headache as UK living standards are forecast to rise more slowly than nearly any other major economy in 2026. The International Monetary Fund warns that growth in GDP per capita, which is often used to measure average living standards, will be only 0.5% next year, as the Chancellor admitted there could be tax rises in next month's budget. According to the IMF's October 2025 World Economic Outlook, the UK is set to record the weakest GDP growth per person among all advanced economies in 2026. The figures are stark. In a blow to Sir Keir Starmer's pledge to raise living standards across the UK, the IMF warned that higher inflation and a weak economy meant real growth per person would be just 0.5% in 2026. That compares with 1.8% in the US and 1.2% in Japan. The Eurozone will also outpace Britain, with growth in GDP per head of 0.9%. The IMF also warned that Britain will experience the highest inflation in the G7 over the next 2 years. In fact, the fund's economists now expect inflation to remain higher in the UK than in countries such as Peru and Senegal, as higher taxes and rising household bills keep inflation higher for longer. What makes this warning even more alarming is the comparison the IMF draws. Britain, one of the world's richest, most developed economies, is now projected to have higher inflation than countries like Peru and Senegal. These are nations that typically face far greater volatility in prices and currencies, often due to weaker institutional frameworks, smaller financial systems, and heavier dependence on commodities. Yet, according to the IMF, the UK's inflation problem will now exceed theirs. That's deeply concerning, because it suggests Britain is no longer behaving like a stable, low-inflation economy. Instead, it's showing the kind of price instability you'd expect in emerging markets, not in a G7 country with one of the oldest central banks in the world. It raises serious questions about why inflation has proven so stubborn in the UK and whether deeper structural problems are at play. High energy dependency, a weaker pound, and rising tax pressures that feed through into consumer prices. In short, the IMF isn't just saying Britain's growth is weak, it's warning that the UK now faces inflationary pressures more typical of developing economies. When the IMF revises its forecasts, it rarely does so lightly. These are global economists who assess fiscal and monetary trends across 190 countries. So a downgrade like this is a serious statement. The IMF modestly increased its forecast for economic growth in the UK for this year, from 1.2% to 1.3%, and slightly downgraded it for 2026, also to 1.3%, amid concerns over the Labour government. The fund attributes this downgrade to several overlapping challenges. First, inflation is proving stubbornly high, pushed up by energy costs, rising import prices, and continued wage pressures. Second, business investment remains weak. After years of political uncertainty and shifting regulations, many firms are still holding back. And third, with the Treasury preparing a budget to plug an estimated £30 billion fiscal gap, more tax rises and tighter spending are on the way, which could slow the economy even further. The IMF also noted that the UK's inflation persistence is unusual for a developed economy. While countries like the United States have managed to bring core inflation close to target, Britain's price growth remains stubbornly above 3.8%, well past the Bank of England's 2% goal. So why does the UK have the highest inflation in the G7? First, inflation is proving stubbornly high, pushed up by energy costs, rising import prices, and continued wage pressures. Second, business investment remained weak. After years of political uncertainty and shifting regulations, many firms are still holding back. And third, with the Treasury preparing a budget to plug an estimated £30 billion fiscal gap, more tax rises and tighter spending are on the way, which could slow the economy even further. Put simply, the UK's cost of living crisis isn't over. It has merely changed shape, from energy and food prices in 2022 to housing services and taxes in 2025. And this matters politically, because persistent inflation doesn't just reduce spending power, it undermines confidence in government management and central bank credibility. Food price rise inflation rose for the 5th month in a row in August, with costs rising at the fastest pace since the beginning of last year, official figures show. The cost of food and non-alcoholic drinks grew at an annual rate of 5.1% as beef, butter, milk and chocolate prices continued to surge. However, despite the increase in food costs, price growth in other areas such as airfares slowed, leaving the overall rate of UK inflation at 3.8%, the same as July. Now, one of the most concerning factors, though not directly mentioned in the report, is the UK's astronomical borrowing cost. The yields on UK government bonds, known as gilts, are now consistently the highest among the G7 nations. Take a look at this chart showing the yield on 10-year government bonds compared with the rest of the G7. This is all the more remarkable because UK public debt is not particularly high by international standards. In fact, the ratio of debt to national income in the UK at around 100% is far lower than in Italy at 135% or Japan at 240%. Even tiny Greece, with debt still over 150%, can borrow at 3.3%. What makes this situation so concerning is the comparison itself. The United Kingdom, one of the world's oldest and most established financial powers, is now paying higher borrowing costs than Italy and Greece, two nations that have long been associated with fiscal instability and fragile public finances. This reversal is deeply unsettling, not just symbolically but economically. To understand why, we need to look at what government bond yields really mean. When investors buy government bonds, or gilts, in the UK's case, they're essentially lending money to the government. The interest rate, or yield, reflects how much confidence investors have in that country's ability to repay. The higher the yield, the more risk investors see. So, when UK bond yields exceed those of Italy or Greece, it suggests the markets now view British debt as riskier, or at least less attractive, than countries that have spent decades fighting debt crisis. That is a shocking shift. Italy's debt is around 135% of GDP, and Greece's is still above 150%, compared with the UK's debt at roughly 100% of GDP. Historically, such a gap in debt levels would mean lower borrowing costs for Britain. Yet today, the opposite is true. Investors are demanding a higher premium to hold UK debt, not because the UK is insolvent, but because they've lost confidence in its long-term economic direction. The IMF's downgrade isn't the only warning Rachel Reeves has received. In fact, some of the world's most influential investors are also sounding the alarm about Britain's economic direction. Their message is simple but serious. If the government keeps relying on higher taxes to plug budget gaps, it could end up driving away the very people and businesses that keep the economy afloat. One of the most notable voices is Ray Dalio, the billionaire founder of Bridgewater Associates.
Ray Dalio is one of the most successful investors of his generation. The founder of Bridgewater Associates, one of the world's largest hedge funds, and one of the few people who successfully predicted the 2008 financial crisis. His track record gives his words a level of credibility. When he speaks, markets, policymakers, and serious investors listen. And recently, Dalio issued a stark warning aimed directly at the United Kingdom, and by extension, Rachel Reeves. He stated the UK is stuck in what he called a debt doom loop. Here's a clip from the podcast.
Debt doom loop at this point in the UK?
Yes, we're in the debt doom loop, yeah.
So talk us through that. How do we get out of it?
The debt doom loop also is affecting capital flows. So the necessity for creating taxations that are then driving people away. They move for their capital reasons. A deterioration in conditions as the financial problems and the social problems worsen, having the effect of causing people to leave, people with money to leave. That's a problem because I don't know the exact numbers in the UK, but they're analogous to the US. 75% of income taxes are paid by the top 10%. So if you lose 5% of the population in that category, half of those people, you lose 35% or more of the tax revenue that comes as a result of that. And so you have this deterioration, financial deterioration, precedes social and economic deterioration that has caused migrations all around the world and so on.
But what exactly does that mean? Why is Britain more vulnerable than the United States, Japan, or Germany? And what does this mean for ordinary people across the UK? What exactly is a debt doom loop? Dalio's phrase is not just a catchy headline, it describes a vicious economic cycle that's incredibly difficult to escape. A debt doom loop begins when government debt levels rise so high that servicing that debt, paying interest, consumes a growing share of the budget. To meet those payments, governments are forced to either raise taxes, which risks driving away investment and talent, shrinking the economy further, or borrow more money, which increases debt even further and pushes interest payments higher. This spiral feeds on itself. Debt creates more debt, higher taxes drive away growth, weaker growth reduces tax revenues, and the government's fiscal position deteriorates even faster. It's the economic equivalent of quicksand. The more you struggle, the deeper you sink. Dalio explains that, unlike the United States, which enjoys the privilege of issuing the world's reserve currency, or Japan, which benefits from deep domestic savings and creditor status, the UK doesn't have such buffers. Britain relies on external investors to fund its deficits, and when confidence slips, borrowing costs spike, as they did during the Liz Truss mini-budget crisis in 2022. This fragility is why Dalio believes the UK is already in the doom loop stage. Wilfred Frost asked Dalio a crucial question during the Master Investor podcast. If the UK's deficit and debt to GDP ratios are smaller than America's or Japan's, why are Britain's borrowing costs so significantly higher? Here's the clip from the podcast.
First, I'll say it's an ugly contest. Like, it's not like your financial picture is good. It certainly isn't good. And so you're right to ask the question, perhaps on a relative basis, but the relative is it's not a reserve currency anymore. Okay. It's not an effective storehold of wealth anymore. Okay. In the United States, okay, there's a certain element of I will buy dollars because I will transact in dollars and that'll be my vehicle for saving dollars and I'm going to buy those dollars for that reason. They're not transacting in British pounds anymore. Okay, that's over. Okay, and in Japan, there's again that very strong home currency bias. In other words, they're a creditor nation. They have a lot of debt, total debt. But at the same time, they have it within themselves. They are a creditor nation to the rest of the world, and the Japanese therefore view risk in Japanese yen terms, and so they're willing to hold that yen that is going down so quickly. And despite the fact that they're having such a lousy interest rate, in other words, they've been brutalized by holding that debt. But since there's a home advantage, then they hold the debt, and that is the basis. So it's the basis of supply and the demand for those reasons.
Why are UK debt costs higher than US, significantly higher than Germany, Japan? Before we listen to Ray's response to this question, it's important to add some context. The UK's deficit currently sits at about 5.7% of GDP, high, but still smaller than America's. Its debt to GDP ratio is about 94%, far below the US at 122% and miles below Japan at 235%. Yet despite carrying a lighter debt burden, Britain is paying much more to borrow. In other words, markets are charging Britain a premium, not because of the size of the debt, but because of the doubts about fiscal credibility and long-term stability. Now, back to Ray Dalio's answer. His answer was blunt. The UK no longer has the credibility of a reserve currency, nor the strong home bias demand that countries like Japan enjoy. As he put it, it's not a reserve currency anymore, it's not an effective storehold of wealth anymore, they're not transacting in British pounds anymore, that's over. In contrast, Japan's debt is held mainly by its own citizens, giving it a much stronger demand base. The US dollar is still the world's reserve currency. Investors and central banks across the globe need dollars to trade and save. Japan, despite eye-watering debt levels, has a creditor advantage and a strong domestic bias for holding yen-denominated debt. Britain, however, lacks both of these cushions. Sterling's no longer seen as a global store of value, and the UK is not a creditor nation. That leaves Britain exposed. International investors demand higher yields to lend money to a country they view as less secure. In short, the UK pays more because the market doesn't trust it the way it trusts the US or even Japan. This is a damning reality for Rachel Reeves, as she is in charge of the helm of the Treasury. Reeves has promised fiscal responsibility after years of turbulence, but the structural weakness of the UK's financial position limits her room to manoeuvre. Dalio highlighted what Reeves faces this autumn. The UK's tax burden is already at its highest level since 1951. Debt levels are at record highs, and despite previous increases, further tax rises are almost inevitable. Reeves is caught in a no-win situation. Raise taxes again and risk accelerating capital flight, avoid tax rises and the deficit balloons further. Dalio stated clearly that difficult choices are going to have to be made. This is where the political challenge collides with the economic reality. While Reeves and Prime Minister Keir Starmer preside over a massive parliamentary majority, making those difficult choices has proven far from simple. Each time Reeves or Starmer attempt to introduce tough fiscal measures, whether it's the controversial move to scale back winter fuel payments for pensioners or the debate around tightening eligibility for personal independence payments, they face resistance from Labour's own backbenchers. The internal pushback highlights the difficulty of passing the very kind of hard, unpopular reforms Dalio insists are essential. Although Labour dominates the Commons, Reeves and Starmer are finding that political power does not automatically translate into the ability to implement the painful changes needed to escape the doom loop. And that's why all eyes are now fixed on the upcoming autumn budget. Rachel Reeves faces a balancing act: reassure the markets, calm restless backbenchers, and convince the public to go with her. Every choice she makes, whether on taxes, spending or borrowing, will send a powerful signal about Britain's direction. Get it right and she may be able to restore some credibility. Get it wrong and the UK could spiral further into the debt doom loop that Ray Dalio has warned about. That's why this budget matters so much. If you found this breakdown helpful and want to stay ahead of the big stories shaping the UK's economy, make sure to subscribe for more.